Valuations and multiples. We get a lot of questions on the process of valuing a business, where we get the data from to value a business and select a multiple. And then, of course, a lot of discussion on multiples themselves, as they are the core of how businesses are priced, right, for sellers and buyers. So there's a couple things I quickly want to do. The first is I just want to point everyone to some resources about valuation. I've got 2 posts out there, a Business Valuation 101 post, where I talk about the process itself of valuing a business, the types. There's 3 different commonly accepted ways of valuing a business, or methods, I should say, and how those are each used. And then in addition, we've got information on the documents that are required and several examples, right, with valuation considerations. Once you read Business Valuation 101, I would encourage you to read Business Valuation 401 as well, right? And that goes into more detail, as well as thinking about your business importantly, from a buyer and a commercial lender's perspective. Okay, so now that we've addressed those resources, I want to show you what a valuation range, like what this actually looks like what is the deliverable when we talk about evaluation. And I would just call out that this is mock data, this is fictional data for a fictional business. So to that end, the first thing we're going to do in evaluation is we're going to look at 3 years of your P&L, and I should say at least 3 years of your P&L, as well as year-to-date results. We're going to put all those together, and we're going to look at key expense categories by percentage, right? And that's going to be the basis of a conversation about your business that we're going to have. In addition, we're going to make a number of different adjustments to normalize the financials. One, to understand what the true owner benefit is for you as an owner of the business, and then also to understand things like depreciation, interest, any non-operating or non-recurring expenses that may be reflected in the multiple year view of the P&L. We're going to go through a similar exercise for the balance sheet. We may spend more time on the balance sheet depending on if it's an asset intensive, right, or capital intensive businesses. Some are and some aren't. If you're a professional services business and you're simply charging for people's labor, then the balance sheet conversation is probably going to be pretty short. Next thing we're going to do is we're going to start to talk about where do we actually source the data from. So here I want to show you another file. So there's 2 primary databases that we use, right? The first is called Deal Stats, and the second is called BizComps. In this case here, this data is for landscaping and tree care. Okay? And so you can see in this case that we looked at landscaping and tree care businesses that have transacted in the last 10 years with revenue between $1 and $5 million, where their cash flow to owner or seller discretionary earnings was higher than $400,000. And we excluded some transactions, right, that were statistical outliers for various reasons. Okay, and that left us with 39 good transactions. And you may be wondering what the descriptions or where those businesses are. And I just want you to know that the database has 199 data points on each of those transactions. You can see it goes out quite a ways. Importantly, here's the description, right? A descriptor of each of those businesses that we review. The first output from the tool is this summary view of multiples here. You can see there's a variety of different multiple types. There's sales multiples, gross profit multiples, and then importantly, there's 3 different types of earnings or cash flow multiples. There's an EBITDA, an EBIT, and then a discretionary earnings multiple. Depending on the business type, we will guide you to the most appropriate multiple to use for that business, right? That's how we'll always encourage a seller and a buyer to think about the business. And that's one of the most common mistakes that we see is people will refer to a multiple and not knowing what earnings yardstick that multiple should be applied to. Next, I think importantly, so this summary view is helpful, but it's not really the basis for a factual conversation with a seller, buyer, or lender. Really what we're looking for is the data dispersion or range and variation in that data set of the 39 transactions. So you can see for these 39 tree businesses, they ranged with revenue from $1,112,000 up to about $4,276,000. Okay, and the columns here in the file, these are the revenue cut points, okay? And you can see how the multiples over time, so here are cash flow or earnings measures. You can see, of course, how the earnings multiples increase as the business size gets larger. It's important for us to look at the data set in more detail in the statistical view, right? Because here we can start to see if your tree care business in Spokane, for example, has $3.6 million in revenue, we know you're going to be somewhere right in this range. Okay, Okay, and so that's where we would recommend pricing the business. In addition to that, this is one of the checks, right? In addition to that, typically look at least 5 other current tree care or landscaping businesses that are on the market now, and we'll look at the multiples for those to see how your business compares to those. So those are just some of the things that go into evaluation. Again, I would if you're more interested in the subject, I would really point you to that Business Valuation 101 post that we talked about and the Business Valuation 401 post. I'm Ryan Hemmer at Washington Business Brokers.